Now that we've gone through some key metrics that have come out in the US, we can shift a little bit more into jobs, unemployment, stimulus, what is happening overall. And that's when we turn to home base. And here you can see the change in small business employment. And you can see that as we go through that 7-day moving average, we continue to see that drift lower, especially on the US side. So the US has been, as an aggregate, has been relatively stable at this down to 25%, which is just doesn't seem to really kind of get any traction upwards, because we get some states get better as others get worse, and we continue to see the small business side continue to struggle. And if you think about how important the small business jobs and revenue and tax revenue specifically are to the underlying cities, states, and just the federal government, you can see that this is going to be a big overhang, because we're really not getting anything really sticky in terms of just that increase overall, as places are going from either temporarily closed to permanently closed, and those individuals just can't find those new jobs, which is creating those bigger issues, as we see just based on that small business employment. Now, when we go a little bit further back and we tackle that school question again, that I think we did a good job of at the very beginning, here we can look at another aspect of it, as you have people who are remote, 3 days a week, in school 2 days a week. Well, how does school closure really impact the underlying family dynamic? And here you can see mothers, more so than fathers, end up staying home. And it's really not so much stop working, but just working less. Again, these are less hours. This is underutilization. This is people that just won't have as much income. So then when we take that to the next step and you look at the recent stopgap that got pushed through the government today, or at least the House passed, there was a bill to increase food spending for $8 billion for children who aren't getting school lunches. Again, like as last week, we talked about food security, we talked about food inflation. This is another problem when you see school closures and these impacts. Now, these could be individuals that need that additional cash. So women staying home 23% of the time, fathers staying home 15% of the time. That is a big problem. And when you look at the aggregate of all parents, you can see just how problematic these school closures really are when we consider that you need daycare and daycare even for anybody. And that's why these pods have kind of popped up. This is going to be a sticky problem that I don't think is truly appreciated, especially as we start going deeper, as we enter into the Q4 numbers. And here's just looking at the percentage of change in those small business openings. And you can see that as we got to August, we had that quick kind of shift lower, and now things are starting to roll back over. Leisure and hospitality shouldn't really be surprising, given that you had places that are open seasonally. Those are starting to shut back down. The bigger issue is going to be education, retail, transportation. These are things that are going to continue to kind of just hang and just, again, kind of go sideways, which comes back to why we keep talking about this plateau, the fact that we can't really kind of get any real traction. These are those examples where people just, businesses just aren't reopening. You have these kind of permanent closures, because even though we had that bounce off the bottom, you can see that the bounce happened, and now we've just kind of gone sidelines down, call it, 25%, 20 to 25%, which again is going to be a problem when we consider like, how do we get to the other side of this overall? And this is when we look at these job losses, you have to consider, it's like, okay, well, return of the same job, like expecting to return to the same job. And now how is that being shifted? And now you're seeing not expecting to return to work, unemployed, not expecting to return to work, employed. That 32% is really important when you consider kind of where we sit in the dynamic. And now, if you go back to the first part of the econ show, when we start talking about consumer sentiment, consumer expectations, this weighs on that. If people are not expecting to go back to work, that 10% is important. Like 86% expected to return to the same job on April 20th. And you can see how that has shifted on July 20th, which again, completely shifts the way you're going to spend, the way you're going to consume, what you feel about or how you think about the economy going forward. This is going to be a big overhang. And it's being reflected in Indeed data. And here we just want to look at the 7-day moving average through September 18th, that you can still see we're down about 18% versus 2019. and 2019 was below 2018. As we consider kind of where we sat, again, as we've been talking about, it wasn't so much that 2020, obviously COVID was a huge factor, was jet fuel in the forest fire, but there were problems already arising. And here you can see that even though we've had a nice bounce from May now, it's just we're getting that leveling off as we get these jobs that are just not really coming back. And when we consider what type of jobs are we talking about, it's important to appreciate the top third of occupation wage tier is at one of the worst. And it's because we continue to see those middle management and even upper management jobs just go away or get consolidated or just disappear altogether. And that is putting that huge overhang. So when you look at even top tier sales, that's where we continue to see some struggle. Now, it takes time for this to happen because these are individuals that will have more savings, will have more 401ks or ways to leverage assets they currently sit on that will kind of prolongs their ability to see those changes in consuming patterns. But again, June, let's call it May to September, now into August, into October, that's going to be a perpetual problem that will start to resonate and start to really impact the GDP overall, PMIs, manufacturing goods, the general supply chain of the way these leading indicators really work. Now, when we look at the impacts and the stimulus, here you can see the start of the recession right here at zero. Then you have that $600 increase in terms of that unemployment benefit. So you had that big increase in personal income. Now we lost the 600. Now there's going to be another rollback. So here you can see this is just Bloomberg economics, based on their estimates. But you look at just the lower range in recessions and the upper range, you can kind of see that we first shot above because the Fed did a lot, the government did a lot, and now you're starting to see a lot of that rollback. And we're starting to see this fall back into, call it, the middle of the road, especially if we don't have any type of new stopgap, which we just don't think is likely, especially ahead of November, which is going to be not only an important election year, but sure to be a very divisive one. So now when we shift and look at it a little bit differently. So now we know that the 600 expired. So looking at the kind of apples to apples, well, how did the credit and debit card spending for the unemployment benefits really shift? So you see the apparel dropped off quickly. Nike had a great quarter. Maybe some people were using their money for different things. But here you see apparel dropped off quickly, but groceries starting to slow down, but not as much just because like that, again, we talked about that food inflation, the food costs. Total is coming down, but restaurants really fell off. But we have to consider what happens with the new rollback of spending, because that's where we think that spending bump is going to come down even further, and you're going to get back into that negative territory. And the reason why we say that is when last week we talked about core retail sales and how core retail sales went negative again. Well, that is, I think, a precursor to what you're going to see and how people are really shifting the way they're consuming and the concerns that they're seeing overall, which is going to be that growing overhang that we keep talking about. And this is, again, talking about that overhang. We'll look at rising permanent jobs and the way spending and retail sales are merging in on each other. So the rising permanent jobs, as we talked about, there were people who were expecting to go back to work. Now they're not. 32% are either unemployed or think they're going to be unemployed. So that permanent job loss is rising, and it's going to inherently pull down the retail sales and just the way retail sales are moving, especially as that CARE Act is operating. And the reason why we keep talking about this, because you're like, Mark, you keep obsessing over this spending, this fiscal movement. And it's because this has really been helping the economy really get that big bump in Q3. And the problem is without a sustainable recovery in the underlying economy, which we keep talking about, that's all it's going to be is that bump. It's not going to get us to the other side because, as we're going to talk about in a minute, the impacts of the Fed have completely gone away. Not that they were there much to begin with outside of inflating prices, but the fiscal bump was real. It was tangible. It was $1,200 in a check. Then it was $600 extra. Then it was $300 in terms of these bumps that are just disappearing, just as permanent job losses are increasing. So this was something where people might have been furloughed and got some benefits, and now they're permanently lost, and now you don't have the money. So this is why we think that there's going to be a bigger acceleration in some of the downward trajectory of some of these numbers, especially as we head into Q4. And this is the bigger component, kind of bringing it all together, looking at unemployment rate. So the unemployment rate is sitting at 6.8%. Again, some people might have fallen out of the unemployment levels. So, we still think that's a little bit low. But the bigger one is we want to talk about underemployment and especially underutilization, coming back to the mother or father that can't work as much because they have to care for their child or they have to deal with, remote learning. That is a big number, which is just going to shave back that discretionary income. And that's not changing anytime soon, especially as we have a little bit of a resurgence of COVID in the US. Again, people just changing their daily patterns, not because they're government mandated, but because they're just naturally trying to, fix themselves or adjust themselves. And those are things that are just going to continue to weigh on just the economic outcome. Now, when we shift a bit and we start looking at just the federal debt level. So when we talk about the fact that we had this big fiscal push, well, let's look at what fiscal pushes have looked like throughout the years. And here you can see the Congressional Budget Office just projecting out to 2050. Again, you have to get an idea of just how bad the debt held by the public really is, and the federal debt in general, and just what the percentage of gross domestic product really looks like. How we've had this big surge. We had a big push from the Great Recession, really started, and then we just got another big bump. And now, just given where we need to be in terms of getting new fiscal stimulus out there, getting some of this new push out there, and the U.S. isn't alone. Europe is doing it. In our OPEC show, we talked about Saudi Arabia is doing it. All of these countries are trying to do the same type of thing, which is, again, leading to this gross overhang of just global debt, which is going to be a problem when you start thinking about velocity of money, getting things back through the market. And here's just looking at global debt to GDP, so taking what the federal congressional budget says, and now let's take it global debt to GDP ratio, hitting that all-time high in Q1 of 252%. Now, given this is just going to be a matter because the BIS data is always a little bit slow in terms of assembling. So we still don't have the data coming out. And we all know that as the new data comes out, based on everything that we've seen on fiscal stimulus, this is going to be a new level higher. And we continue to see these huge overhangs of just debt that's just been laden. And the problem is, if you look from 2008 to today, the idea is that if you think about the Keynesian model of you stimulate in bad times and then you tighten in good times and you start to take back. Well, you can see from 2008 to essentially 2011, there was no tightening. There was a little bit of a taper tantrum, and then things continued. So even though we had technically 128 months of growth, you didn't see any type of tightening anywhere in the world, which again puts us at a precipice of a bigger problem, especially as we try to get to the other side of COVID. Now, when we talk about the velocity of money and kind of where things are shifting, so here you have the money supply increasing and you have just the loans coming down. So we've talked about this in the past in terms of, banks are just unwilling to lend. We've talked aggressively about tightening lending standards. What are lending standards doing? Like, why are they getting worse? And it's just that is continuing to roll out. So the commercial bank assets, when we're thinking about commercial and industrial loans, they continue to fall even as the Fed continues to increase their money supply. So that's just less money being moved into the market. So when you think about the velocity of money, again, it's just a calculation. So when you think about the price of things, the economic throughput, and then the money supply, the money divided by the money supply is the denominator. So if you have prices, going up, creeping higher because we have inflation in different places, but the throughput just isn't there, you just get this overhang, which is why the money supply continues to go down because the denominator keeps getting bigger. So when we just look at trying to get this money into the system, it's failed. It's just not getting to where it needs to go, which comes back to the Cantillon effect. And maybe you redirect the entry point. So does the Fed all of a sudden say, look, we're going to go straight to the people? We can't go through the banks. These are things that we have to consider when you start to see this big divergence, because the Fed just isn't getting dollars through the system because banks aren't lending. And when we consider banks aren't lending, well, where aren't they lending? Because we see mortgage rates, we see all these different things. Well, they're not lending to the commercial side. So we have a drop in commercial paper. The industrial side, the small, medium, even some large industries can't get the borrowings that they need from the banks. And here's just another backdrop in terms of total debt balances among U.S. households. So not surprising, housing debt has increased. As we know, people are moving into homes. They're spending more because rates are so low. So here you can see the housing debt is going to continue to increase, and it will continue to creep higher, especially as the new data comes out for the second and third quarter, as we know that there are just people buying more homes. And this doesn't really capture all of that. But the percentage of changes remains student loans, which has been a huge overhang if you consider the movement of again, back to that velocity of money. So when you look at housing debt has an asset. Like, you have a home. If something goes wrong, you sell the home. Well, student debt, what is the asset? What is your collateral? What is your collateral? How do you essentially protect some of these numbers? And that's why student loans remain some of the, if you look at just the inflation of it, why some of this has to really start to adjust as the inflation numbers have to come, as this inflation has to come down and pricing has to come out, which again is going to come back to, well, how does total debt balances at the household work? Because you can see that they may have discretionary income, which, as we've talked about in the last 10 minutes or so, continues to drift lower, which is going to be a huge overhang for just when you think about managing the household income and discretionary cash. But when we look at existing home sales continue to trend higher. They came in right about estimates when you look at existing home sales. And then the inventory remains at record lows. And if you think about kind of where we sit, it makes a lot of sense, because you had a relatively low base of inventory. You had people immediately trying to leave the cities and the urban areas, and that's gotten the adjustment. Now, as we go forward and we start projecting into 2021, when you have foreclosures starting to increase, you have homes that were under construction and permitted and they're starting to come online, that is going to be kind of the shift. But regardless, right now, you can see home sales are increasing, inventory is low. So what does that do? That drives up pricing. So here you can see that over the last 12 months, pricing has increased across the board. We've had about a 1.3% increase on overall, if you look at the US. But the biggest growth has really been from that west, north, central, east, north, central. So you're starting to see those moves as people move out of the urban areas, move into the more suburban, rural spots, because they want to take advantage of having more space and starting to diversify away from those urban settings, because they can work from home. They want more space, given the fact that they experience what a pandemic feels like, and it's just time to move on or expand the family, whatever, in terms of just people shifting out of the cities, with New England seeing the biggest price increase. Again, coming back down to where you're going to have the least amount of supply, you get an idea of kind of where things sit. But that is why we're seeing these huge price increases, which is, again, is it going to be continuous as we go through 2021? I'm going to say no. But again, it's just going to come down to supply, demand, and what do those mortgage rates really look like, which remain low. So this is why you're starting to see those price increases, which I believe are going to start to fade, especially as we get into the second half of 2021, as that new supply comes on, as foreclosures and short sales increase, as I think people might be now a bit more price sensitive, if you will, as you start to see job losses increasing in terms of just that discretionary income, which is going to impact down payments. So now that we've really talked about the US, I think it's time to really kind of go a little bit bigger and look at Europe and just overall GDP on the global aggregate, to kind of look at how are things shifting overall.